The private markets are not as complex as some may think that they are. In fact, it's very similar to buying equity of a company or debt of a company. It's just that it's not traded on a publicly traded exchange. The private markets aren't bogged down with some of the same regulatory burdens that the public markets are. Second thing is that there's been a massive amount of liquidity in the system because of intervention that has been taken by the Federal Reserve since the Great Recession. And then lastly, there's been some really big names that have come from the private equity market and become public, like Alibaba, Facebook, Salesforce. These are some of those names that have sparked some interest into the private market. There's private equity, there's private credit, and then there's real assets. The most common is the private equity market. Investors can either invest directly in a company, but the majority of the time investors are getting access to the private equity market through a fund. There's really three main types of funds. There's buyout funds. This is where a fund manager is going in and trying to get a controlling stake in the company. There's venture capital funds. These tend to be the riskier of the three. This is where the fund managers are going in and investing in small startup companies. And then there's growth funds, and these are more mature companies where the fund manager is going in to try and restructure the company, make it more profitable. The private credit market is that, buying credit of specific companies. Typically, these are small companies that don't necessarily have the ability to access the public markets at affordable rates. The two main areas of the private credit market are mezzanine and senior debt funds. They tend to lend to lower or middle market borrowers. And then there's distressed debt and investing in distressed companies. And what those fund managers are trying to do is find those discrepancies between where the debt is priced and where the ultimate recovery rate may be in the event of a default. Real assets are something that you can physically touch. They have tangible value. Real estate, infrastructure, and then there's natural resources. All of these types of real assets not only offer portfolio diversification, there's the potential that they can offer an inflation hedge, also an income stream for investors. The major difference is that private markets are not traded on publicly held exchanges. But there's really four other key differences. First of all, there are barriers of entry for the private markets. Typically, the private markets are held for accredited investors. And that's different from the public markets where anybody with a cell phone these days can open up an account and trade publicly held stocks. The second one is that private markets do not have to be bogged down with the additional costs of the regulatory burdens. They don't have to report as frequently as publicly traded companies. The third thing is that private markets, because they're not priced on a daily basis and typically have a long-term time horizon, they're not subject to some of these daily volatility swings that we've seen in the public markets. And the last thing is liquidity. The private markets typically require you to lock up your money for a specific period of time, but the goal in that is to get a better risk-adjusted return with less volatility. The most important thing is due diligence. When you invest in the public markets, most of the information about the company is readily available to any investor at their fingertips. But that's very different in the private markets. They're not required to file certain regulatory requirements that you have in the public market. So it really takes a good dedicated due diligence team, which we have here at Verdance, to look within each private deal and make sure that it's the appropriate value for each individual investor. Private investments play a very important part of a well-diversified portfolio. In an environment where the investment world is evolving regularly, just a traditional 60-40 split of stocks and bonds is not offering not only the same level of diversification as it once did, but also not the same risk-adjusted rewards. That's where private markets come in. They're less correlated to the public markets, don't deal with the same type of volatility, and offer investors a good risk-adjusted rate of return. Why are we talking about private investments now if we've always thought they were part of a well-diversified portfolio? It comes down to the economic cycle. In the past several years, we've seen a significant amount of money being put into this private market space. Well, now that we've had a turn of a market, a recession, and some major distortions, this is where private equity managers and private credit managers can really come in and find that opportunity. The private markets are truly a very interesting part of our investing world. So if you have any questions at all, please feel free to reach out to any one of our financial advisors.